For more on China's stock exchange, its economy, and the world markets, let's talk to Jack Perkowski in Beijing. He's the managing partner at JFP Holdings, a provider of financial and business advisory services. Sir, welcome.
Thank you very much.
I want to start with perhaps you giving us an explanation, the correlation between China's stock market and its economy. No question that there is volatility in the stock market, but is that a realistic gauge of China's economy? The fundamentals is what I'm talking about.
Not necessarily. Let me give you a couple of examples. In the year 2000, when China's economy was $1.3 trillion in terms of GDP, the Shanghai Composite was about 2,000. Almost 15 years later, in July of last year, when China's economy was 10.4 trillion, the Shanghai Composite was still at 2,000. So in 15 years, despite the fact that China's economy had grown by 8.5 times, the Shanghai Composite was exactly the same level. Likewise, from July of last year until June of this year, the stock market, the Shanghai Composite, went from about 2,000 to just over 5,000. Yet, in spite of the fact that all the news about the economy slowing and so forth is something that's been in the news for a long time. This is not new news. So so the stock market moves are not always linked to what's happening in the real economy.
So why are we seeing this type of erratic up and down, and mostly down lately, in China's stock markets?
Well, basically, I think what Beijing is trying to do is they're trying to shift household savings away from bank deposits and property investments into things like the stock market, where that money can then be used to get into the hands of private companies, SMEs, that can be used to drive the economy. So, for example, China has $21 trillion of bank deposits. That's twice the level of its GDP. That's twice the level of bank deposits in the United States, which is a larger economy. So what China's trying to do is to move that that cash into things like the stock market, and that accounted for, I think, a big part of the rise over the last year. Now, of course, anytime you have a very big increase in stock values, you're going to have a correction. And so what we're seeing now is a correction, and I think there was an overuse of margin lending, which kind of led to this volatility, this recent volatility on the downside.
And who are the people, Jack, that are investing in China's stock market? From what I understand, only about 2% of the Chinese people own shares. They are extremely active on the stock market. So tell us about who the typical investor is.
Okay, keep in mind that many of the companies that are listed are state-owned enterprises. So if you look at the shares outstanding, about 60% are owned by their parents. About 22% of the shares are owned by individuals, and there are about 50 million active investors in China, and they own 22% of the shares. Unlike the United States, which has a high proportion of institutional ownership, institutions only account for about 11% of the shares outstanding, and foreign investors only account for 1.5%. So it's a heavily retail market, and the individual investors are the ones who are most active in terms of trading. So they own 22% of the shares, but they account for, for 80–90% of the trading that's done.
Do you think what we've seen in the market is going to perhaps spook these investors from investing? From what I understand, many of them actually borrowed money to invest in the stock market.
No, that's correct. And stock market moves are a combination, or due to a combination of greed and fear. Obviously, when the stock market was going up, people wanted to make money, and so they rode the stock market up. However, the higher the market goes, what the market's doing is building in sellers. And so as they start to sell, and particularly as the margin debt unwound, it really created this huge downward pressure on stocks. I think the one encouraging sign is that margin debt today is about $125 billion in China, which is about half of what it was in June. So there's been a big unwinding of a lot of this debt, and I think as that plays itself out, you might start to see stability in the market.
And we've seen the fifth interest rate cut since November, Jack. Is that more for stabilizing the stock market or helping boost the economy?
I think it's both. I think it gives confidence that the government's doing something that, that's proven to work in other markets in the past. When you have these kind of market corrections, putting more liquidity into the system is always a good thing. But it's also aimed at the economy. So, it's pointed out that this is the 5th interest rate cut since November. And keep in mind that at 4.6%, those interest rates are still very high compared to countries around the world. But because there's been this downward pressure on interest rates, we're seeing, for example, that the property prices seem to have bottomed out in the first half of 2015, and July was the first or the first month in 16 months when the property prices, home prices, increased in more cities than where it decreased. So the interest rate cuts not only help the stock market by putting liquidity into the system, but they also help the real economy, is showing up now in the property sector.
And Jack, very quickly, when the markets open in less than 15 minutes, what do you think we're going to see? Up or down?
I don't know. That's a hard one to to predict. I don't know. I think it's going to stabilize somewhere in here. So whether it's today or sometime this week, stocks don't go up forever and they don't go down forever either.
What must go up, what goes up eventually comes down, and vice versa.
That's
Jack,
right.
Jack Perkowski, thank you so much.